let's establish what has been happening. And there's only one reason why markets are rallying right now. Don't look at it too deep. It's not that deep. The markets are rallying because people are starting to expect inflation will come down by the September Fed meeting, and the Fed will give us a smaller rate hike, maybe a 50 basis point rate hike, or even if the data comes down in a bigger way, maybe only a 25 basis point rate hike. That's what the markets are expecting. And the real problem here is, if inflation does not come down, well, we have rallied way hard and you would come down way fast. So what essentially we have going on over this weekend is not too much in the sense of things that are going to move the markets, but you did have this, and this is Fed Kashkari. So are we in a recession was the question he was asked, and he says it doesn't matter. Fed official says, I'm focused on the inflation data. And the key points: Neil Kashkari, president of the Federal Reserve Bank of Minneapolis, told CNBC's Face the Nation that inflation poses a larger threat than a potential recession. Quote, we're going to do everything we can to avoid a recession, but we are committed to bringing inflation down, and we are going to do what we need to do, Kashkari said. And that's the same thing as pretty much what Fed Jerome Powell said. Fed Jerome Powell said if the inflation data warrants the Fed going more aggressive, that they would do, quote, an unusually large rate hike. That could be as high as 1% or possibly even higher than that, depending on how the data comes in. And the markets right now, they're really taking a sigh of relief because we don't have the next Fed meeting until September 21st. So that means you get the CPI report for July coming August 11th, and you get the CPI report for August coming September 11th. That is going to be 10 days before the Fed meeting. And by then, a lot of investors are expecting inflation to have come down. Now, there's still the problem there is if inflation might come down a little bit, but what if it doesn't drop off? Investors right now are really expecting inflation to drop off, but we're at 9.1% CPI. Year over year, we are way higher than their 2% mandate, and the Fed still wants inflation down to 2%. So depending on how that data comes in, that's really what is going to mark if we are at a bottom or not. It's one thing for the Fed to give us information that we already knew. Of course, they were going to slow down the rate of rate increases. Of course that was going to happen. Nobody argued that, right? And you know, we've really priced that in very aggressively as if the Fed has already U-turned. So depending on how the data comes in, that is really what is going to move the markets. As of right now, about 90% of investors are expecting a 50 basis point rate hike. Nobody is, about 10% of investors are expecting a 75 basis point rate hike. Pretty much nobody. So that's what we have. Make sure you guys watch this if you guys are in active trades, or if we do have a big red day or a big green day, you want to watch the Fed futures, and you can do that by going to investing.com/Fed rate monitor tool. Now, on top of that, for this week specifically, and we're going to talk about the data that is coming out right now, there's a couple things that will have an impact to the market. So on Monday, tomorrow at 10 a.m., you actually get the ISM manufacturing PMI. This is a reading of inflation, right? So that will be important. And then you get to, I believe it's Tuesday, you have JOLTS job openings for June at 10 a.m. That will also be important. The more jobs we keep, aka the less unemployed people we see, is potentially a bad thing for this whole Fed U-turn, because if the job market continues to suggest the Fed can keep raising rates and inflation is not coming down in a meaningful way, well, the Fed is going to look at that and say, yeah, we can still keep raising rates because people are not getting laid off. There's still a lot of jobs out there, and we're still seeing hundreds of thousands of jobs created every single month. So the Fed is not concerned about really anything else besides maximum employment and inflation. It's not their job to feed into what the market's narrative wants to hear. It's not their job. They like to use the markets to help them get inflation down or bring it up, depending if they do quantitative easing, quantitative tightening, and other things that they can do. That dives into the Fed a little bit more than I want to here in this video. This is only about what is going to move the markets. Now, on Wednesday, you have ISM non-manufacturing PMI, and that's the one that's probably going to be more important because non-manufacturing, well, you know, there's a lot of the economy that is non-manufacturing as well. That is for the month of July. That comes out at 10 a.m. Factory orders month over month for June also at 10 a.m. And then a lot of these other data points as well. ISM non-manufacturing prices, ISM non-manufacturing new orders, ISM non-manufacturing employment, so on and so forth. All of that will be important. Now on Thursday you have the balance of trade for June, and this is basically the trade deficit. So we'll see how this comes in. This is helping to get us to that negative GDP print that we have seen in Q1, negative 1.6%. In Q2, the estimate that we got on Thursday was negative 0.9%. So the balance of trade, something to watch. Not too convinced that that's actually going to move the markets, but hey, we will see. Now on Thursday you also have Fed Mester that speaks at 12 p.m. and I should point out on Tuesday as well at about 9 a.m. you do also have Fed Evans, and I believe on Monday we might have a Fed speaker as well. No, it does not look like we have a Fed speaker. Fed Evans is at 10 a.m. on Tuesday. My apologies there. Fed speakers will be important because if we start to see a lot of Fed speakers that are saying they support another 75 basis point rate hike, well, that's not priced into markets, and that would be new information that the markets did not see coming. Now, the U.S. unemployment rate, it's been pretty steady at about 3.6% unemployed, which is almost historically low. We get that reading coming out for the month of July at 8:30 a.m. on Thursday, or on Friday we get that, and then non-farm payrolls as well, 8:30 in the morning on Friday. Participation rate, 8:30 a.m. Average hourly earnings year over year and month over month. Government payrolls, average weekly hours, participation rate. You get a lot of employment data on Friday, so it looks like every day this week will be important, and you will have at least one data point. I will say right now, the Fed speakers, the unemployment data, and the ISM manufacturing and non-manufacturing PMI, those are going to be the most important things to be watching for, and then that's throughout this whole week. So we'll see what happens with all of that. I'm not a fortune teller. I don't know how it's going to come out, but that's what is going to move the markets. As far as everything else you guys need to know, on Friday we did get PCE as well. Core PCE and normal PCE did edge up yet again. The markets had initially sold off on that news on Friday. If you pull up the 1-minute candlestick chart, you could see that was this whole sell-off that we got. Right in here was the PCE report that did come out, or I believe it was right here, either right here in the beginning of trading or right here. You got the PCE. It came in hotter than expected. Markets sold off for a minute and then completely disregarded everything else. And you guys can see 6.8% year over year. That's another high. And that is the main reading of inflation that the Fed likes to pay attention to. So, you know, we're already getting bad news about inflation. Markets didn't care, so I'm not going to try to forecast, you know, if the markets are going to care about ISM or not. To a certain extent they will, but will it derail a rally? Not convinced on that. Not convinced on that. But what could is actually earnings. So on Monday and after hours, you have Diamondback Energy, Activision Blizzard, Avis Budget Group, Simon Property Management, and that's pretty much it. Tuesday pre-market, Uber, Caterpillar, BP, JetBlue, Marathon, Marriott International, Air Canada, even Ferrari. Tuesday and after hours, you have AMD. That's going to probably be one of the biggest market movers throughout this whole upcoming week. Tuesday, AMD and after hours, PayPal, Oxy, SoFi, Airbnb, Starbucks, Gilead, and those are going to be the companies I want to watch the most, and that's probably going to set the tone for this whole week, to be honest with you guys. Given the data that we get on Monday, given the data that we get on Tuesday, plus earnings, that's probably a majority of the market moving events for this week. But Wednesday in pre-market, you have Under Armour, you have Moderna, CVS Health, Regeneron, Generic, Yum Brands, and that's pretty much it. Wednesday and after hours, Marathon Oil, Energy Transfer, Lucid, Robinhood, Booking Holdings, and that is pretty much it. Thursday pre-market, Alibaba, Kellogg's, Crocs, Datadog, ConocoPhillips, Paramount, Eli Lilly, Penn National Gaming, and Thursday and after hours you have AMC, Square, Warner Brothers Discovery, Fubo, Twilio, Carvana, Southwestern Energy, and Cloudflare. And on Friday, you have DraftKings, Canopy Growth, and Cinmark. So as far as earnings this week, you do have some big companies. I mean, Square, AMD, Uber, those are probably going to be the most important companies for the stock market. Starbucks, Airbnb, a little bit, but you want to watch the sectors here. For an example, when AMD reports, that will move semiconductors, that will move Nvidia's, that will move, Qualcomm's, that'll move those kind of stocks, which could have a bigger, broad market impact. Same thing with Under Armour. Watch Nike, watch the consumers there, watch those kind of companies. Hopefully you guys get the idea here. Same thing with Lucid. Watch GM, Ford, Tesla, all those guys to be sympathy moves or sympathy trades to electric vehicles, to Lucid. So there is all of that information. Looking like a pretty eventful week, but definitely the markets are in a pretty bullish trajectory as of right now. Also, mortgage rates fall sharply after negative GDP report and Fed's latest hike. The average rate on the popular 30-year fixed mortgage fell to 5.22% on Thursday from 5.54% on Wednesday. Now, what comes with cheaper interest rates, mortgage rates, car loans, credit, personal lines of credit? Well, recessions come with that. So what you're actually seeing right now is the markets are pretty freaked out about a recession, and the markets are expecting the Fed to U-turn and pretty much bring down these interest rates. So the markets are trying to get ahead of that, and they're also trying to price in that recession. Now, the yield curve inversion is still pretty bad out there, guys. Keep that in mind. Yield curve, we'll go ahead and pull this up over on CNBC. You guys can keep this up for yourself as well. I like to keep it up in its own tab because it can give you a glimpse to what's going on in the markets, how investors are feeling. Obviously, yield curve being inverted, 23 basis points, the largest and longest inversion we have seen since the year 2000. Always forecasts or precedes a recession, so keep that in mind. Inverted 23 basis points, very, very large, and that basically means that investors are selling off 2-year bonds. Investors expect inflation to be over 3%. Over the next 2 years, and they do expect to some degree a recession and the Fed making an error and breaking something, whereas they are buying the 10-year bonds because they do have faith in the longer term inflation expectations. So the more the 10-year inflation expectations get derailed, and potentially the more fear there is over the next 2 years, that's will kind of be a leading indicator of the yield curve inversion getting a little bit deeper. So some things to pay attention to there. Overall, guys, I just want to say this. The markets are going to do what they want to do. Make sure you guys have your long terms. Make sure you are buying the dip, you are investing, you are doing all of that, and preferably times like this, you should be investing more money. But we have seen a very big rally from the bottom. Let's go ahead and pull up the percentage gain that we've seen. You've seen about a 14% move from the lows back to where we are right now. So there's a lot of meat on the bone, and it does look like stocks are kind of starting to get a little bit toppy. I mean, if you take a look at something like an Apple or an Amazon, I mean, Apple is over its 200-day moving average. Apple in a couple good trading days is going to be up at all-time highs again, and I just don't think that is warranted based off of pretty much what the Fed has said. The Fed said they will either go less aggressive or more aggressive depending on inflation data, and it's not really the time, in my personal opinion, to get gung-ho in one direction or the other, because we don't know what inflation is going to do at the end of the day. Everyone has been wrong. If you are buying stocks right now and actively buying calls, playing this bullish trajectory, I don't blame you. But if you're doing that, you got to know what you're doing, or you got to have a strong inclination that inflation is coming down. If inflation does not come down, that August 11th reading and that September 11th reading, the markets will hit new lows. That's a given fact at this point. So that's going to be all for this video. Thank you guys for tuning in. Hopefully you guys learned something out of this video. If you did, hit the like button, subscribe to the channel, show the video a little bit of love. YouTube algorithm, help push this video out to as many people as possible. Hopefully people can get this information in time to start the trading week coming tomorrow. You guys enjoy the rest of your day. Get your free stocks down below in the description. In the meantime, I will see you in the next one.